Hello everyone, today's video is all about pre-year end tax planning. Now let's assume you've got a limited company, you're making widgets, you've got a trading business, husband and wife, and you've got a March 31st year end. So one of the classic ways to get the corporation tax down is to pay into a pension from the company, corporate pension contributions. Now the limits are £40,000 each director per year, but if you haven't done the previous years, you can carry the excess forward and do that. Now, assuming in this scenario, the husband and wife have maxed out earlier years, but they haven't done this year. So right now they could do 80 grand this side of the year end. So they get in 80,000, 40 grand each from their company into their pension. That would trigger corporation tax relief for the year ended 31st of March 23, 19%. It's going to save about 15 grand of corporation tax. Now, here's the thing. Let's assume this company has got a few quid, and ideally what you'd want to look to do is say, right, well, what about if we do next year's contribution right at the start of the tax year? Now next year, remember, we're talking about two slightly different years here. We've got the financial year of the business, which runs from the 1st of April to the 31st of March. And we've got the fiscal year end for income tax and various things, which everyone knows runs from the 6th of April to the 5th of April. So those annual allowances for pensions are actually tied into the fiscal year. So you've got to make sure that you're doing the right amounts between 6th of April and the 5th of April. So what about sort of double loading, as it were, and getting another contribution in as soon as you can after the financial year, but in the next fiscal year? In other words, waiting a few days until the 6th of April and doing another chunk then. Now, that is also when the new rates of annual allowance kick in. So the new threshold is 60,000. It was 40,000. Budget 23 recently bumped it up to 60. So in this scenario, husband and wife can put in two lots of 60 grand on the 6th of April. So two lots of 40,000 right now, the last week of March, and then 120 grand from the 6th of April onwards. So say on that day, and that's 200 grand going into their pension in quick succession. That saves an awful lot of tax relief. Now, again, some of the tax relief will be in the company's year ended March 23, some of it will be March 24. But the point is, why wait till same time next year? Why do you always have to top up your annual pension allowance just before your company's year end when we're talking about pre-year end tax planning? You don't have to do it right at the end. The corporation tax relief is the same whether you do it at the start or at the end. The reason you choose to do it at the start is because you've got another year of your money being invested on the markets, which with a fair wind, you'd expect to do better. Now, listen, I'm not giving investment advice here, but as a rule of thumb, why have it sat in cash in a limited company? If you didn't need it for working capital, get it invested in the pension, on the stock market or commercial property or whatever, but get it invested, 11 months, 11 and a half months, nearly a full year earlier than you would otherwise have done had you left the planning to the same time next year. So this is all about thinking about getting double hit. So two lots of annual allowance pension contribution, particularly the fact that it's going up, so you can do 120 instead of 80 for a husband and wife director team. And you got that extra time horizon to make a few quid on investments. So, and the other thing as well, of course, is just from an inheritance tax play. Now, inheritance tax has changed. They've changed the rules on pensions. The fact that the annual allowance has gone up, but the lifetime allowance has been abolished, which means you can pass on pension pot, inheritance tax free, depending on what age you are when you die. But as an IHT vehicle, pensions have all of a sudden become a lot more attractive than they were. Everyone thinks of pensions, corporation tax relief or income tax relief and tax-free yields, but as an IHT play, it's worth thinking. Now, especially, let's say, what if this surplus cash could cause a bit of an issue in this company? Because let's say, God forbid, the directors, the husband and wife, one of them or both of them were not very well, and all of a sudden they passed away and owning shares in this trading business that they spent many years building up. Now, normally, when you die owning shares in a trading business, that's exempt from inheritance tax. It falls outside of your estate. It's called business property relief. It's a bit of a misnomer because there's nothing to do with property really. But It's called BPR, and it basically means you've got a trading company and you die, no inheritance tax. Great. However, not so great if HMRC deem you to have too much surplus cash or indeed investments knocking about in here. You know, if this company had way more cash than it needed or some assets, investment assets, potentially that IHT relief can be denied. And then there'd have to be inheritance tax, possibly on the value of the shares in the companies. That's another reason for getting money out of the company, getting it into the pension, knowing that pensions can pass down generations IHT free. So why jeopardize the loss of BPR relief on your trading company for surplus cash, particularly when you could get it out 2 bites of the cherry in quick succession and get the corporation tax relief. So it's basically saving on corporation tax, it's an inheritance tax planning, and getting on the stock market and making a few quid earlier on those investment choices. So just an overview there on some tax planning around the recent changes to the annual allowance, the lifetime allowance. I hope you like this video. If you do, please do subscribe. And as always, I'll see you soon.